So your crypto exchange collapses and suddenly your assets are just gone. The financial hit is instant, but figuring out how to claim that loss on your taxes, well, that's a whole different story. It's an absolute minefield of complex rules and really high-stakes choices. Today, we're going to navigate that minefield together, breaking down the Internal Revenue Code to figure out what the options really are for investors who are caught in this mess. And this quote from the Department of Justice on the FTX collapse, it really sets the stage perfectly. You see, that distinction between a failed investment and intentional fraud is the exact pivot point that can change everything about an investor's tax situation. It's the difference between a pretty small tax benefit and a potentially massive one.
Okay, so here's how we're going to break this down. First, we'll look at the core problem. Then we're diving straight into the tax code itself, specifically IRC Section 165. From there, we'll explore the two main paths for deducting a loss, look at a really interesting proposal based on past scandals, and finally, we'll clear up some common confusion about wagering rules.
All right, let's just start with the reality of the situation. After platforms like FTX, Celsius, and Voyager went bankrupt, countless investors found their assets totally frozen, inaccessible, or just gone. They were left as unsecured creditors, hoping to maybe get a few pennies back on the dollar. And that leads to the big question on everyone's mind. My crypto is gone. Can I claim a tax loss? And if so, how? When your account is locked and the best-case scenario is getting a tiny fraction of your money back, the very next thought is whether the tax code can offer any kind of relief. And the answer is, well, it's complicated. It all depends on how that loss is characterized. To answer that question, we've got to dive into the rulebook, and that means getting familiar with Internal Revenue Code Section 165. Think of this as the foundation for all loss deductions. Every single potential path for a crypto investor starts right here. Okay, so let's get right into the code. Section 165, subsection A, gives us the general rule. It says there, shall be allowed as a deduction any loss sustained during the taxable year and not compensated for by insurance or otherwise. That last part is key. If you got an insurance payout, that reduces your loss. But otherwise, this is our broad permission slip, the basic principle that says, yes, you can deduct a loss, but the limitations are coming. And here they are. For you and me, subsection C narrows that broad rule down to just 3 categories: losses from a trade or business, losses from transactions you entered into for profit, and finally, casualty or theft losses. Now, for most crypto investors stuck in an exchange collapse, it all boils down to a strategic choice between number 2 and number 3. And believe me, that choice changes everything. So let's kick things off with path number 1, the most common, the most straightforward route for any investment loss, treating it as a capital loss. This path takes us straight to subsection F, which is all about capital losses. And since the IRS treats crypto as a capital asset, just like a stock, this seems like the default natural fit. But look closely at the wording. It says losses are allowed only to the extent allowed in sections 1211 and 1212. That little phrase is where the serious limitations kick in. And here's the bottleneck. You can have a massive loss, but the tax code forces you to squeeze it through this tiny opening. First, you have to use it to offset any capital gains you might have. Then, after that, you can only deduct a mere $3,000 a year against your ordinary income, like your salary. So if you lost, say, $100,000, at that rate, it could take you over 30 years to fully deduct that loss. So you can see why that capital loss route isn't exactly great for large losses. This brings us to the second pathway, which is definitely more complex, but also a lot more powerful: the theft loss. This is the high-stakes option for investors who believe they were victims of outright fraud. Now, subsection E is where things get really interesting. This is our theft loss. And the first crucial point is that you claim the loss in the year you discover it, not necessarily the year the theft actually happened. And for tax purposes, theft is a really broad term. It includes things like embezzlement and larceny, the exact kinds of crimes being alleged in cases like FTX. But, and this is a big but, you can't just declare it a theft and call it a day. The burden of proof is on you, the taxpayer. You have to establish that a theft actually happened under state law, calculate the amount of your loss, which is basically what you paid for the assets, nail down the exact date you found out about it, and finally show that there's no reasonable chance of ever getting that money back. And this is why it's worth the effort. The capital loss path is a slow, painful trickle limited to that $3,000 annual deduction against ordinary income. The theft loss, on the other hand, is like a rocket. It allows you to deduct the entire loss as an ordinary loss against your ordinary income all in the year you discover it. The difference is truly night and day. Okay, so we've established that the theft loss deduction is way more powerful. And with all the talk of fraud, a really compelling argument is being made to treat these crypto collapses just like another infamous type of financial crime. Specifically, the proposal from groups like the California Lawyers Association is to apply the exact same guidance the IRS created for victims of the Bernie Madoff Ponzi scheme. The logic here is pretty simple. If a crypto exchange was misappropriating customer funds, it was functionally a theft, just like a classic Ponzi scheme. If this proposal is adopted, it would open up what's called an optional safe harbor for investors. This would let them deduct a fixed percentage of their loss, say 95% if they're not trying to recover funds, or 75% if they are, without having to prove every single element of the theft on their own. Basically, it gives you a clear, straightforward option. And finally, there's one more thing we need to address. It's this persistent myth that you could treat these crypto losses as wagering or gambling losses under a completely different part of the tax code. We need to clear that up. Now, Section 165D is very specific about gambling. It says you can only deduct gambling losses up to the amount of your gambling winnings. Simple enough. A 2017 amendment changed some details, and thankfully, a later IRS Chief Counsel memo, that's AM 2023-006, tells us exactly who that change was meant for. And you don't have to take my word for it. Just look at what Congress itself said in the committee report. They stated the change was aimed at the individual's gambling activity. They even said the whole point was to reverse a specific court case, Memo v. Commissioner, which had let a professional gambler deduct his business expenses even after he'd wiped out his winnings. So the bottom line is this. The IRS has formally looked at this and concluded that this entire section of the code, Section 165D, applies only to individuals who are in the trade or business of gambling, professional gamblers. For a typical crypto investor, even a very active one, this is just not the right legal framework, period. And that really leaves us with the big question. The world of financial technology moves at lightning speed, but tax law, it moves deliberately, carefully. As the legal system continues to sort through the wreckage of these huge crypto collapses, the path it ultimately chooses, the painfully slow capital loss or the powerful theft loss, is going to have massive financial consequences for a whole generation of investors.